Welcome back to the deep dive. We grab the sources, break them down, and get you up to speed fast. Today, we're tackling a big one in cybersecurity, Fortinet. We're digging into their Q3 2025 results, but maybe more importantly, the strategy behind those numbers, what they're calling their three pillars.
Yeah, it was a really solid quarter for them, very strong. Looking at the top line, you saw 14% year-over-year growth in both billings and total revenue.
14%, okay. Pretty consistent there.
Right, but maybe the bigger story, or just as important, is the profitability. They actually hit a record third quarter non-GAAP operating margin, 37%.
37%. Wow. In this kind of business, that requires so much R&D that really stands out. It makes you think of that benchmark, the Rule of 45. For listeners maybe not tracking this day to day, what does hitting the Rule of 45 tell us about a company like Fortinet?
Well, it's kind of a gold standard, right?
Yep.
Especially in tech and SaaS. It's simple. Your revenue growth rate plus your operating margin should add up to 45 or more.
Okay.
So Fortinet, with 14% revenue growth and that 37% margin, they're hitting 51. Management sounded really confident too, saying this looks like the sixth year in a row they'll hit it in 2025.
So it's like a quick signal to investors. We're growing, yes, but we're also really profitable while we do it.
Exactly. It signals strong financial discipline alongside that growth.
Got it. So that's the financial picture. Our mission today, though, is to get behind those numbers and really understand the strategy. Fortinet says its success comes from going after three huge converging markets.
That's right. There are three pillars: secure networking, unified SaaS, and AI-driven CCOPs. And, for you listening, this isn't just corporate jargon. It's really a snapshot of how a major player is navigating this convergence of networking, cloud, and now AI and security. We need to see how they're trying to win on all three fronts at once.
Okay, let's unpack them one by one, starting with the pillar that had the most, eye-popping growth in Q3, AI-driven security operations, SecOps.
Yeah, CCOPs. That was the fastest growing segment for them. Billings were up an impressive 33% year over year.
33%.
And what's really interesting is the foundation they point to for that growth.
You mean their IP, their patents, building that sort of AI moat.
Precisely. They mention having over 500 issued and pending AI patents. And these aren't just sitting on a shelf. They're apparently powering over 20 different AI-driven solutions in this pillar.
So it's not just about finding weird activity, it's automation, threat hunting.
Right. Automated response, better modeling, scaling defenses way beyond what people alone can do. And just to give a sense of scale, the trailing 12-month ARR, annual recurring revenue for CCOPs, it jumped 25% to $472 million. It's a huge focus area for everyone right now.
Okay, so if CCOPS is kind of the future battlefield, the next pillar, Unified SASE, sounds like it's about getting to that battlefield securely. SASE, Secure Access Service Edge, emerging cloud, and network. What stood out there?
So Unified SaaS billings, they grew 19% year over year. Solid growth. But the really dramatic number was in their SaaS delivery. Fortinet SaaS billings specifically for SaaS grew over 100%.
Whoa, over 100% in one quarter. For SaaS billings, that sounds like really rapid adoption of the cloud model.
It really does. It suggests customers are moving quickly to that cloud-delivered SaaS model.
So if I'm a big company, why pick Fortinet SASE sauce now? What's the draw?
I think the key word they stress is unified. A lot of vendors offer SaaS pieces, maybe as separate cloud services. Fortinet's pitch is that they're bringing together access management, firewalling, SD-WAN, all under one roof, one system.
Simplification.
Exactly. That's driving adoption, especially in large enterprises. That segment grew 55%, pushing their overall penetration there up to 15%. And the total recurring revenue for SaaS, the TTM ARR, is now over $1.2 billion. $1.22 billion to be exact.
Okay. Pillar 3 then, the bedrock. Secure networking. This is their traditional firewall strength, network gear. Billings grew 10%. How does that fit in with the faster growth elsewhere?
Well, they frame that 10% as actually outperforming the broader market, which is seen as more mature, right?
Yeah.
They still claim the top spot in firewall unit market share, over 50%.
Still dominant in volume.
Very. But the interesting angle within this pillar is their push into, let's call it, non-traditional networking areas.
You're talking OT, operational technology.
Yeah.
Securing factories, power grids.
Exactly that. OT and critical infrastructure security, which falls under this pillar, saw billings growth over 30%. That's significant.
Why is that area heating up so much?
Well, think about it. Utilities, manufacturing plants, all these physical systems are getting digitized, but often run on older protocols. They need specialized, really rugged security. Fortinet seems to be using its hardware expertise to win those kinds of big critical deals. It shows networking security isn't dead, it's just finding new places to protect.
So 3 pillars, all growing, all claiming to beat the market. And you mentioned big deals earlier. The value of deals over $1 million is up over 30%.
Yeah, over 30%. That suggests they're getting deeper into those large strategic accounts. And often, those big deals are about consolidating, simplifying.
Which leads us right into the next part. Those big deals often happen because customers want less complexity, lower costs. So let's talk about Fortinet's core differentiators, the tech they use to win those arguments. 2 key things, right?
Right. Two main pieces. First, the software side.
FortiOS, the single operating system. Why is having just one OS such a big selling point when everyone else seems to be talking microservices and breaking things apart?
It really comes down to the simplicity pitch. They say they're the only vendor that natively integrates the next-gen firewall, the SD-WAN, and the SASE functions all onto this single OS.
Okay.
Imagine being a large company trying to manage like 8 different security tools from different vendors for your network, your cloud access. It's a nightmare.
For sure.
FortiOS aims to simplify that. Better visibility, consistent policies everywhere, easier training for staff.
So you can go from just a basic firewall to a full cloud SASE setup without ripping and replacing everything, all managed in one place.
That's the idea. Makes sense from a management standpoint. But then there's the hardware piece, which might be the even bigger differentiator. Their custom ASICs.
Application-specific integrated circuits. This always comes up, their secret sauce.
It really is. Most competitors use general-purpose CPUs, like the chips in your computer, maybe some off-the-shelf network processors. Fortinet designs and built its own chips, these ASICs, specifically for security and networking tasks.
So if I'm buying this stuff, why should I care if it's a custom chip or an Intel chip inside? What's the actual benefit?
Think of it like a specialized tool versus a general one. A regular CPU is okay at lots of things. An ASIC is designed to do maybe fewer things, but do them incredibly well. In this case, security processing, and crucially, using much less power.
Okay, so performance and efficiency.
Right. Their claim is pretty bold. 5 to 10 times better performance than competitors. That means potentially lower energy bills. Total cost of ownership, you need fewer devices and definitely lower energy bills.
And that energy saving part is incredibly relevant right now, isn't it? Especially with AI. You mentioned a specific example.
Yeah, great one. A big global e-commerce company, Fortune 150, was expanding its setup for a new AI workload. They specifically chose Fortinet's ASIC-based gear.
Why?
AI needs huge throughput, super low latency. The ASICs delivered that, but the real kicker, apparently, was the power consumption.
They cited up to 69% lower energy use compared to alternatives. That's huge.
It's massive, especially now when AI computing is straining power grids. If you can handle the intense security needs of AI data flows and cut your power use by nearly 2/3, that's not just a tech choice, it's a strategic business decision.
Okay, so the ASICs deliver speed and efficiency. Now, there was another interesting customer story that showed the flexibility of the FortiOS platform, maybe challenging the idea that SaaS has to be pure public cloud. The police force deal.
Ah yes, the sovereign sauce example.
Right.
An 8-figure deal with a large city police department.
What was the challenge there?
They had really strict local rules about data governance, data control. They needed the modern features of SaaS, but they couldn't just put sensitive police data into a standard public cloud service.
So sovereign SaaS means...
It means Fortinet let them deploy the entire Fortinet SaaS software stack inside their own data center.
Ah, okay, so they get the
Yeah.
unified management, the modern architecture, but the data stays physically under their control.
Exactly. That flexibility let Fortinet win the deal, displacing older vendors who couldn't offer that kind of on-premise, yet still SaaS-like solution. It shows the platform can work for public cloud, private cloud, or traditional on-prem setups.
A very specific but powerful differentiator for certain customers.
Definitely. Highlights that adaptability.
Yeah.
Kind of like another win they mentioned, a retail customer upgrading security across more than 10,000 stores. Basically sticking with Fortinet because the single FortiOS platform was just simpler and offered better price performance to them.
Okay, so strong growth driven by this unified hardware-software approach. But let's turn to maybe the one slightly cloudier spot in the earnings call. Service revenue. Product sales grew strongly, 18%. Billings were good at 14%, but service revenue only grew 13%. And that growth rate has been slowing. Analysts definitely picked up on that.
Oh yeah, absolutely. That was kind of the elephant in the room. Service revenue, things like subscription support contracts, is seen as a key indicator of recurring health, future stability. So seeing that decelerate makes analysts ask questions.
Management had an explanation, though, a pretty specific one, involving a time lag. Can you walk us through their argument for why they weren't worried?
Their argument relies heavily on historical data. They basically said, look, service revenue always lags behind product sales.
How much of a lag?
They put a number on it, typically about 29 months. The logic is a customer buys a firewall today, that's product revenue hitting now. But the associated support and subscription contracts might not fully ramp up or hit their main renewal cycle, generating peak service revenue, until, almost 2.5 years later.
Okay, so the argument is that strong 18% product revenue growth we just saw in Q3. That's the leading indicator. We won't see the service revenue really pick up because of that sale until sometime in 2026.
Pretty much. They specifically projected that service revenue growth should start improving again in the second half of 2026, driven by the product sales happening now and recently. They're essentially telling the market, be patient, the growth is baked in, it just takes time to show up here.
It's a clear explanation, but I guess the question is, do analysts fully buy that 29-month historical lag in today's market? Things are changing so fast with SaaS and AI. Does the old firewall hardware cycle timing still apply perfectly?
That's exactly the point of tension. The 29-month number might be solid based on past firewall cycles, but yeah, skeptics wonder if the shift to cloud services like SASE might shorten or change that lag somehow. Management, however, seems confident, and they stress that they aren't just relying on old hardware getting replaced. They're driving growth through innovation.
Right. They're not just waiting for a refresh cycle. How are they pushing new product growth then?
Primarily through new features and better performance. They highlighted two big things coming up. First, on the software side, FortiOS 8.0 is planned for launch next March at their Accelerate conference. New features in the OS often create reasons for customers to upgrade or add services.
Makes sense. And second, back to the hardware.
Back to the ASICs. To keep that performance edge, they're planning to release a new ASIC, the MPA ASIC, next year. It's expected to be several times faster than what they have now.
Faster chips again.
Yeah, and specifically aimed at boosting their growth in high-end data center firewalls. Tying back to that need for speed and low latency we talked about with the AI data center example.
So management's long view is that even without big refresh waves, they can maintain, like a 10 to 15% normal product growth rate for the next 5-10 years? Just by taking share.
That's what they project, yeah. They believe the markets for their three pillars are so fragmented, there's plenty of room to keep gaining share from competitors, justifying that kind of sustained double-digit growth.
All right, let's wrap this up. Fortinet's Q3 looked financially very healthy. Great margins, solid 14% growth in billings and revenue. The core message seems to be that their engine, that combination of their own software, FortiOS, and their own hardware, the ASICs, is working. It drives down costs for customers and makes it easier to consolidate.
Yeah, they seem to be executing well on that multi-front strategy, pushing hard into the high-growth areas like CCOPS and SES, while still holding their ground in traditional networking and even finding new growth there, like in OT security.
And they backed it up by reaffirming their full-year 2025 guidance, midpoint looking at about $7.4 billion in billings and $6.75 billion in total revenue, shows confidence.
All right. Which leads us to maybe the final thought for you, the listener, to consider. Fortinet is fighting on three massive fronts simultaneously: secure networking, Unified SASE, AI-driven CCOPS. Together, that's a market heading towards, over $300 billion by 2029? And it's incredibly fragmented. No single company has more than maybe 10–20% share in these areas. So the challenge isn't really creating a market. It's prioritizing within these huge existing ones. The question is, how do they keep that core advantage, the speed, the cost savings from their integrated tech, sharp and effective, while trying to lead across three enormous, fast-changing security landscapes all at the same time? Can they maintain focus?
A great question, where deep strategy meets the messy reality of the market. Thanks for joining us for the deep dive. We'll catch you on the next one.